Sunil, it's been a shakeout. It's been a big shakeout in the mid and the small cap space. Is this sign of things to come, that the froth in the market is getting cleansed and now markets will revert to their mean? Because it's been a great quarter, so to speak. August, September, early part of October for investors have been nothing short of breathtaking. But is it time for a reality check?
I think partly what you say is true, Nikunj, in terms of the froth going away. But I would also say it's a time for a sector leadership change. I think the rally that so far driven was entirely liquidity driven. So anything where there was earnings visibility, right, of some sort went up, right? Now what's happening is that I think that we are at a kind of a bottoming out of the Indian economy, and there are still lots of sectors where there are stocks which are very reasonably valued but which have not got their attention. Now the focus is shifting forward, and I think this is a leadership change. And a leadership change cannot take place without profit booking on the one hand, because you need that cash to be deployed afresh. There is fresh money coming in to some extent, but still, I would say a lot of the domestic, institutional, and retail participants would be rejigging their portfolios with a view to the future. I think that's what is also playing out. So profit booking with a view to redeploying in the sectors of the future.
What are the sectors of the future? Because everything which has potential to grow is already trading at a multi-year high, or valuations are higher than historical average, whether it's banks or metals, whether it is IT or a combination of consumer tech. What is that there where growth is looking strong and prices are still attractive? Because I have to think hard. Last year, I would have rattled off 10 names where there was growth and there was price comfort. Right now, there is growth which is visible, but it's like saying this market is now offering gold at the price of diamond.
See, Nikunj, but the point you have to take is that this is a problem with the linear thinking. The issue is that we look at the past profit growth and project it and say that valuations are expensive. So if you just take a look, right, I think because of the COVID crisis and because of the previous downturn, right from December 17 onwards, right, corporate profits grew only by about 0.5% for an extended period of time. But you just project forward, FY 2022, that 3-year cycle, corporate profits are expected to grow at 51% per annum. And the next cycle, that is 22 to 24, they're expected to grow at 15% per annum. Has a market discounted this? Partly only. So I would say that, yes, not every expectation is going to turn to reality. So there will be negative surprises, but there will be lots of positive surprises too. So when you ask me which sectors, where is India? India is at a 7-year corporate capex low, right? At the same time, corporate balance sheets have deleveraged tremendously. Demand is seeing a V-shaped recovery, and soon, if you go by the commentary in the earnings season, lots of corporates, they are announcing capex, and second, they are saying that they're going to run out of capacity in a couple of years from now. So the capex cycle turn up, right, is ideally positioned. Interest rates are soft. Government is spending on capex, so there is demand for capital goods from the government side. And private sector is announcing capex. So I would say the leadership will be coming from the classic industrials, building materials, capital goods suppliers. Those are the sectors where I see a very sharp V-shaped uptick in earnings, and as more sustainable, maybe a 5 to 7 year bull run in the economy for these sectors. And I don't think the market is anywhere close. So I would argue that while 1 year back you had value in terms of the fact that market was just ignoring them, today you have growth available at a reasonable price. The issue is, what do you think that growth is going to be? Now, if you look at it and say, 20% per annum looks too rich, I would argue that that's not the case, because when you're coming off a bottom, numbers like I said, 20 to 22, 51% per annum corporate profit EPS growth, if you take a bet on do that, obviously people will say you're buying an overvalued market. So I would say that look at it with the data on hand on what India is going to become. A sustained decadal high single-digit growth is in the realm of possibility. And I think from that perspective, right, I would say that not all of the market is overvalued at this point of time.
A lot about autos, Sunil, and you made a point that look, auto had a terrible 2018, a horrible 2019, and a pathetic 2020. 2021 is no different. After 3-4 years of stress test, are auto stocks looking attractive? Because if I look at what Tesla has done last night in terms of an stock price, it may be a vote for innovation, but it is not it is not like auto sector is dead.
No, I agree with you. So auto has disappointed in terms of the previous 3 years in terms of expectations, because I think the first wave and the second wave both hit demand very severely. But today, auto, I would say that two major problems which hit them recently are, one is the whole semiconductor shortage, right? That causes supply shortage. The second issue is the input cost rise. If oil prices rises, there's a spillover effect on the auto sector. So naturally, there was a pressure. But right now, they are in a fairly sweet spot. Why? It's a very rate sensitive sector. So interest rates for housing loans, auto loans, all are at all-time low. One, there is flush, the system is flush with liquidity, all with all the banks and the NBFCs. And the third thing is, with the festival season, I expect that uptick. And the boost which is going to come to the auto sector is in terms of, you mentioned Tesla there. So the EV, I think India is probably ahead of the curve in terms of pushing for EV. And while 2030 was stated, there is going to be capex in the auto sector, and those stocks, those companies which have a clear-cut EV strategy and start implementing will demand higher valuations. So I would say yes, auto. And the fourth and the final leg on the auto is that the auto component sector is one of the most export-sensitive sectors. And India, as you know, exports has been seeing a boost. The PLI scheme has come in and given a big push to that. So auto component exports will also come and support that sector. So to me, overall, the auto, I think for the year 22 is looking like a good bet.
Good morning, Sunil. Because you're talking about the festive season and you've spoken about auto, what about real estate? And, because that's a multi-year cycle, a lot of the stocks, like look at DLF, it's not even hit its IPO price of 2008. Would you increase your allocation as far as this goes?
To the housing-oriented real estate sector, absolutely. We think that there's a huge, probably 5 to 7 year boom in the housing sector on the anvil. Right? Again, the same reasons. It's a rate-sensitive sector. It's going to get strong support, both fiscal and policy-wise, from the government, because the real estate sector is the largest employment generator. And as we head into the 2024 elections, employment is going to be a key factor on the agenda. And hence, I expect the government to full-on support the real estate sector with whatever it needs. And I think that the fact that people have not purchased houses over a significant period of time. Today, the differential between a post-tax interest cost on a housing loan at 6.5% housing loan, and you take a person of 40% tax, you're talking about sub 4.5% is the effective interest cost. And if you take rental yield at, let's say, 2% also, it's just a 2.5% investment from your side. You are in a position to buy a second house, a third house, and a fourth house, right? So I think that kind of property as an investment, housing property as an investment, is going to get a fresh boost because of these confluence of factors. And I think that the government will support it fully. And I think that, yes, so real estate, again, is part of those sectors I just spoke about with Nikunj, where the market, because of its linear thinking, just cannot predict, because they are high operating leverage, high financial leverage companies. So even a small increase in top line leads to a phenomenal increase in bottom lines. So I think it's hard to sit and predict and use a calculator to say, oh, they grew at this percentage over the last 3 years, they will grow at that percentage. Impossible to predict. And I think the winner will take it all. So I think you've got to keep very stock specific in your approach overall in that sector.
If you look at your top 5 sectors, at least the last earnings season's outperformer, IT, has the smallest weightage of 9%. This earnings season also, you've seen good numbers come out, margins under pressure because of attrition. Another point that you were just talking to Nikunj about. How should one look at IT, and considering the valuation run-up that we've seen, including in the tier 2 companies?
I think IT is an essential component of a portfolio, whether it's large, mid, or small, right? Despite all the factors that you say, I think there are 3 strong headwinds for IT, right? So the first headwind is one which I believe that as the US gets back to the growth path and the dollar strengthens, the rupee has to weaken. Because as US interest rates rise, RBI, which so far has accumulated its reserves and allowed a gentle depreciation, will be forced to have a sharper depreciation, otherwise interest rates will get hit. So I think our view of a weakening rupee over the next decade is, I think, strongly positive for IT. The second thing for IT is that I think we've been through this Y2K kind of a moment with the pandemic, right? With the whole world moving into digital, moving into internet, moving into cloud, moving into AI. It's affecting such a lot of areas that I think that business for IT, the demand is going to boom, go through the roof, right? The third thing that's favorable for IT is that I think India, though we started along the ITES, cost-based kind, I think we have made a brilliant move in terms of our companies going on to the value addition part. So I don't think there's a threat from any other countries in the region in terms of where the BPO industry got hammered with, Philippines and other countries coming in very low cost and all that. In these consulting kind of areas, which is where IT is moving into, right? I think that India has still a sweet spot, and the proof of the pudding lies in the kind of salaries that are being offered in the IT sector, and there's a labor shortage actually happening in the IT sector. So I think that the only thing is that the market, much of this is in the public domain. So the market has discounted a lot of this. So with all of these bright growth prospects, I would say that IT forms a safety aspect of your portfolio, which should be there, but clearly it's not going to be the multi-bagger. But so what? It's so the certainty and safety element of your portfolio is equally important as going behind, multi-bagger kind of a return. So I think IT is an essential part of one's portfolio for the coming 5 to 10 years.
Interesting. So, Sunil, is there a conscious strategy right now, given that mid-caps had a great time in the sun and the fall as well is steeper right now? It typically is, given the high beta nature of some of these high-flying mid-caps at least. So is there a conscious strategy in place to perhaps wean out of mid-caps and deploy an allocation to large caps at all from your end?
Not necessarily true, because as I was mentioning to Nico a few minutes earlier, I think there's a sector change, a leadership sector change happening in the mid and small cap space. So there will be profit booking in what's already gone up, but I think redeploying it within the mid and small cap in terms of the future growth sectors, there's ample opportunity, right? One, you talked about whether we will allocate more to large cap. That will happen if there's a tapering related large cap correction, which brings down those valuations. Because today, if you look at it, large caps are, because of the FII flows are also at very reasonable to, higher valuations, right? So necessarily shifting into large caps when there is the liquidity support from FIIs, which is at some point of time going to go down, because tapering is a matter of time before the US economy recovers, and tapering is going to be a reality. Because tapering is not when, tapering is, not if, tapering is about when. So there will be times to buy large caps when that kind of a tapering related announcements, actions happen. And that's when we'll step in and buy those large caps when they come down to reasonable valuations. So I think a flexi cap approach is the best, right? Not necessary that we've got to look at the Capco based valuations and make shifts. I think it's about finding the growth opportunities at the right price. So growth at the reasonable price, it should be the mantra, and it will come in large caps at some point in time, and that's when we will accumulate those.
Okay, Sunil, great to have you on the show. Thank you so much for taking the time out and joining in today.
Thank you.